We now move into our first panel of the day. How to make India more attractive to LPs. Marketing India. That is what this panel is going to be discussing. Please join me in welcoming Vice President Harbour West Partners, Mr. Kelvin Yap. Joining him is our first panelist for this session, who is the founder and managing partner of Vigo Capital Partners, a private equity firm based in India. Please welcome Mr. Achal Ghai, founder and managing partner, Vigo Capital Partners. Our next panelist is an investment director. Prior to joining Squadron Capital in March 2008, he was with Sequoia Capital's Indian investment team based in Bangalore. Please welcome Mr. Anand RP. Joining the panel now is a chartered accountant with a post-qualification experience of more than 23 years. I give you Mr. Puneet Shah, partner and head, private equity tax, KPMG. Our final panelist is the managing partner of Baring Private Equity Partners India and a senior partner and global board member of Baring Private Equity Partners International. Please welcome Mr. Rahul Basin, managing director, Baring Private Equity Partners India.
Hi, good morning, everybody. So this panel, we're trying to discuss the topic of how to make India more attractive to limited partners. Looking at the VCCH data, fundraising has actually increased from $2.5 billion in 2010 to some $4 billion last year in 2011. I would say with that kind of growth, what I'd like to ask the panel today, and maybe I'll start off with the GPs on my left, Rahul and Achal, is what sort of returns do you think are required to attract LPs to the Indian private equity asset class? Perhaps, Achal, do you want to take that first?
No, I think the expectation, if you look at the last couple of years, I think the world has had a very sobering effect in terms of where the capital has gone, where people have actually, I think when 5 years ago, everybody was looking at north of 25% IRRs. I think in morning, in SAD's morning research, we talked about 21st. I think that's a bit unrealistic. If you really look at where the world has gone, I think we're looking at, if you take premiums to the stock market, premiums to other asset classes, because it's illiquid, it's a long-term asset class. But I would say that would probably be, Kelvin, just to answer your question, should be a reasonable expectation of good returns.
If I could turn over to Anand as an LP, how do you view asset allocation across the globe? So maybe I'll try to segmentize it to the developed markets, which Rahul had mentioned. It's a struggle.
Okay, two very good questions. And on the first point of asset allocation, emerging markets versus developed markets, the point is a lot of money which get allocated to an asset class like private equity or alternatives as a whole, is most of it is still from developed markets. And when people there allocate that capital, I think they allow to not just look at growth in emerging markets, they should also look at some things which are very fundamental, like currency. You have to worry about currency movements. If you are a US dollar or a Japanese yen investor, there is a lot of safety in having things in your own currency because you have to pay your pensioners in your own currency. Then there is also aspects, there are definitely pockets of good opportunities in even those markets. We should not actually write off everything like the West is going to hell kind of point of view, which some people actually have. But we have to understand that these economies are still very sizable. There are a lot of real assets which are sitting in there. And if you take a contrarian view, this may be actually a good time to go and grab some of those assets.
A few good points that Anand had brought up. One is the foreign currency. So towards the early half of last year, all the way up to August, now focus on that one particular point. How would you manage this? How would you manage this to convince LPs that the FX risk maybe more than what it seems on the cover?
No, you see, I think we keep talking about private equity being a medium to long-term asset class. But if you really look at private equity players, I mean, we were not as panicked as we knew it was an aberration. And yes, you have to factor in, when you look at returns, you have to factor in some currency depreciation if you see the last 10 years, last 7 years, last 5 years. But I think a sudden fluctuation which took all of us by surprise really shouldn't bother private equity players, because you're looking at a 3 to 5 year horizon on each investment. I think even currently the rupee at 49.25 or whatever it is today, there is room to for the currency to actually do better. So Rahul, I don't know what's your perspective.
So I think that our own skill sets in managing a lot of these has to become more sophisticated, and we can't sort of say that, I'm an ostrich, I will just manage my companies and see that they do well and not worry about anything else, because the reality is that LPs don't care how well your companies are doing. LPs care as to how well your IRRs are doing and how well your cash on cash is doing. So I think that the bar of sophistication of our industry has to go up. To a point that I was alluding to earlier, I think the way that we all look at our businesses has to change. We've got to first understand that, we are managing investment dollars as fiduciaries, and we have to generate returns. And then we have to relook at our business and say, what are the things that are going to affect those returns or give me opportunities, and create those strengths in-house. It would change the paradigms on, how we define asset classes and how we measure them and how we manage them. But I think that if we don't do it, the environment's changed on us, and according to me, it's changed permanently. We'll all become extinct. And those who actually look at the environment and reinvent themselves and reinvent their businesses, I think there's lots and lots of opportunity.
Rahul, maybe you could enlighten us a bit on how you see valuations, how has valuations been historically in your eyes, and how do you feel valuations are going to be coming in the coming 1 to 2 years time frame? And I noticed an interesting survey that was shown up on the board just now, that some 29% of the surveyed LPs, some 60 surveyed LPs, believe that valuations are going to decrease in the coming year, as opposed to 11%, so only a third of that 30% expecting valuations to increase. Do you share that thinking?
No, I don't think valuations are coming down anytime soon. I think if you look at global capital allocation, you look at the January allocations, you can see that emerging markets have gotten a higher allocation, and you can see the India weightages have gone up, which means the benchmark indices have gone up. If you look at the flows into India since Jan 1, it's almost been $4.5 billion of new equity money which has come in, and the debt is even higher than that. But for markets like India, I think it's the higher degree of flexibility in terms of, which part of the balance sheet to operate in, and, how liquid or illiquid, or whether it's from the market leader to purest private equity or controlled transactions. I think that should be left more to the GPs, and you should ensure that the GPs have the skill to execute against it, rather than try and predefine it. We found, our life has got better, our returns have gotten better, the more flexibility that we've got, and we've actually got flexibility only over a period of time. And I think it's worth considering that LPs should not drive misaligned incentive structures with their GPs.
How do you think the evolution of the Indian GP landscape will be, given some of these things that Rahul's mentioned has happened, right? We've seen it happening. What do you think is going to, the fallout from that to the community, and the resulting implications to capital flows, LP capital flows into India, so the attractiveness of the asset class as part of the evolution?
Actually, it's it's not any different in India than any other emerging markets or even developed markets when they were starting off in the story of private equity, where any business, when it's an interesting business, will attract many entrepreneurs. In this case, it's private equity fund managers who want to start that business. And some will have a very good early track record and they will continue to attract capital, and some may not and they won't. Specifically in Indian context, I think the few things which are going to evolve is, given the nature of India, given the nature that there's a lot of quality companies which are there sitting in public markets and all, just like what Rahul alluded to, many good fund managers in this country will actually get more flexibility from LPs in being flexible in investing either in, I'm not saying different strategies, but companies which are either public or private in some cases, or even different parts of the capital structure.
There are a couple of linked issues here, Calvin. I mean, what surprises me these days still is that there are emergence of a lot of emerging GPs still in India. And Anand alluded to the point that given the last 5 years, I think that we should be fairly mature to a certain extent. It will always be emerging to some extent. And I think LPs, I get very surprised when I see people raising $50 million or $100 million as first-time funds, even now. Obviously, LPs are giving them the money. So I'm not against that, and that's always nice. But I don't think you can do justice to build strong teams on the ground, to be able to add value and make changes in companies, play the devil's advocate, blow hot, blow cold. You have to keep the relationship with the entrepreneur going. Given the legal, I think Rahul alluded to it earlier, given the nuances of the legal system, how to enforce your corporate governance and other rights. It's important to have the relationship. It's also important to make changes at the operating level. So we've always believed, I think we've had our share of change of how we want to evolve as a GP, and I'm sure Rahul has had that as well. You've got to continually make the changes, get the flexibility from the LPs, even on, not only on changes of your team, but more importantly on the investment strategy in terms of tweaking it as we go along. And the market is really changing. I mean, today I don't see too many transactions happening in PE. We talk about $4 billion being raised. Where are the deployment opportunities right now? I mean, what foxes me is that everybody seems to be in the market for fundraising. And I think there is a genuine capital overhang in India in terms of deployment. And if you're going to pick up substandard deals, as Rahul alluded to, or Kelvin, you talked about, they're obviously going to suffer later. And we've actually gone through that learning ourselves in the early days of 2005, 6, and 7. And if we, as a mature kind of, relatively, as I said, as Anand says, a relatively mature GP now in our segment, if we have to make those mistakes now, I don't think we'll get any forgiveness from the LPs.
I have a different perspective to, this thing that about operating managers being very important, etc. I think our ultimate game is to generate good returns. If we need operating managers to generate them, we must have them. If that's what's going to be the key driver of returns, then it's very essential. But my ideal investment is an investment that I make, whether it's a buyout or anything else, and I have to visit for a cup of coffee every 6 months and say, hi, you guys are doing a fantastic job, you're busting all budgets, thank you so much, and walk away. That's ideal for me. The sad truth is that real life almost never works that way. And yes, we have a team which is more than 50% operating people. More than 50% of our partners are actually operating partners. But we didn't figure out this as a strategy that, which sounded good to LPs or this thing. We figured it out because the first investment we ever made in our lives blew up on our faces within the first month of our getting in there. And we thought we'll hire new management from outside to fix it, and guess what? No one was ready to join. So we had to go fix it ourselves.
Great, that's an excellent framework. I encourage limit partners who are in the room to use that framework to interview your GPs before making investments in the hope that all of us will be backing the right GPs, making India a much more attractive place for private equity going forward. When we talk about asset allocation globally, there is also one other topic which is of utmost importance to the LPs, and it surrounds regulations around your investments. So I'd like Puneet to perhaps elaborate a little bit on things that's happened in the past couple of years, lost a lot of money because of some tax structure. How should LPs be thinking about these tax challenges when they decide whether to allocate money to India? Because obviously regulation will be one of the things that you score a country on.
I think that's a very relevant question, and the entire discussion which we had for last half an hour or so in terms of what returns you generate from India, and we're talking about high teens and several other returns and several other factors which are impacting the returns from India, like you're talking about foreign currency fluctuation, you're talking about risk management, you're talking about valuations, and all those factors are absolutely important. But if your structure is not right, if your taxes are not managed properly, then obviously everything can come to naught. It can actually result into negative IRRs, as it could happen in several cases which have been reported and which are actually not in public domain, but where things have gone wrong on the taxes and regulation side, people have suffered very heavily, and therefore I think, to my mind, it's equally, if not more important topic for LPs as well as GPs in that sense, in terms of returning money back to LPs. So essentially two parts. One is on the taxes. Lot has been done till now, but lot more needs to be done. That's one thing which I would strongly believe that which needs to settle down in the Indian bureaucracy, so to say. I mean, I'm aware in terms of some of the FDI data last year, which has actually decreased in India as in big countries, while all other countries it has gone up. And sometimes popularly we call it Vodafone effect, because people are worried in terms of putting money and whether they are going to get your returns tax-free in that sense.
Thank you, Puneet. So with all these realities of life, I turn back the original question to Anand. How do you think investors would view the PE asset class in India, and what is your comment on the future of this asset class here?
Okay, try to keep this short, but simply the PE as an asset class in India is definitely still an interesting space for any alternative asset class investor across the globe. In terms of evolution, I really think that the best and the rest will actually peter out. It has already started showing in terms of who are the good guys to back and who are probably in the margin and who are the guys whom you don't want to back. And that differentiation will clear out even more in next coming 2-3 years. So that is actually a good thing for LPs to kind of have better heart in putting money behind the better fund managers. So what we may actually sit probably in the same dais and talk 5 years down the line will be like the 5 or 10 best fund managers in India getting completely over allocated. They're trying to raise $1 billion and they get $5 billion chasing them. It can be the scenario. So I think the future is actually good, and it's just the normal process of evolution for private equity in any market, and it won't be any different in India.
Excellent. I'd love to finish on a positive note. So with that, maybe ask the floor if there are any questions, and please indicate if you're specifically directing it to one of the panelists.
Yeah, Samir Mehta of Atlas. Actually, two questions, one to the GPs and a couple to the LPs. One observation we've had with our experience with GPs globally, globally as well as in India, is the amount of education we're having to do with the GPs in India around involvement of LPs, certain best practices beyond the anchor or the investment committee teams seems to be very variable in India, partly because it's first-time GPs to a large extent.
So probably I can just start off quickly on the best practices. I'll just say a couple. Look at if you're a GP, look at your business like you're an entrepreneur who's going out there bootstrapping and starting your business. So first thing, typically if you're an entrepreneur coming for money, I was a venture capitalist. I'll actually ask him whether are you mortgaging your house to start your business, literally, so that you will lose your shirt. If my money goes, your money also goes, and you're going to be starting up from beginning. So I know that most of the GPs won't even do it, but at least put enough money in your fund so that it is really going to hurt if the fund don't make good returns. Obviously completely going to hurt if it don't return capital. Second is ensure that you share the profits of the firm completely inside the team, because that's what happens, and that's a root cause of turnover in Indian private equity funds primarily. Because many times, I'm not saying in everybody's case, but many times incentives are misaligned. There are one or two people inside the team who take majority of the carry on a short term or a long term, and the remaining in the next level, people don't see an opportunity to go up, and they say, hey, why not I go for a better salary somewhere else, or why not I spin out and start my own fund? So that is the second mistake which GPs should avoid. These are the two best practices which.
My comment to the LPs and the GPs here, if you're finding that you have GPs who don't treat you right and don't act as your fiduciary and your trustee, you shouldn't deal with them. You should disengage with them as quickly as possible. My own belief is that if you take a single dollar from somebody is important enough for you to take money from them, then you better treat them, then you are their trustee after that. You have to be transparent with them, you have to engage with them, you have to look out for their interests. On the second part, I think, I want to share with some of the people in this room, because I've been at this now for a decade and a half, but I must say that early in my career, I was kind of intimidated by similar kinds of conversations, and I want to caution all of you not to. It's very important to drive accountability and to drive professionalism and performance within your own units, and this is for the GPs. And if that means by having to do that and to reward the performers and separate out those not performing and not doing well, and that leads to turnover, do not blink from it. Stick to that course. I think it is very important. What ends up happening very often is that GPs, in an attempt to make sure that there is no turnover, because, oh my God, what will LPs say, lose sight of the fact that ultimately, if they don't earn returns, those same LPs are going to hang them anyway. So don't lose sight of, how to get the job done and get it done well, and, keep that professionalism, which would be there in any professional organization. Keep that accountability, keep that alignment of authority and accountability going within your firms. In the long term, your LPs will figure it out and you'll do fine.
Just to add to that, it's also quite important to see how much of the upside the corporate house will share with the team who's really doing the deals. Because otherwise, I won't think that there will be team stability.
One final question, if any? Great, thank you very much. Thank you to my fellow panelists.